$103. Silver just shattered $103. Gold is at $4,888, knocking on the door of $5,000. And if you're watching this right now, if you've been holding physical silver while your family called you crazy, while Reddit mocked you, while CNBC told you to buy tech stocks instead, this moment right here is your vindication. But listen to me very carefully. This is also your most dangerous moment, because right now, at this exact second, the banks that spent a decade suppressing this market are about to deploy every psychological weapon they have to get you to sell. They're going to crash at 15% in 3 days. They're going to say it's a bubble. They're going to parade experts on television telling you to take profits. And if you fall for it, if you sell your physical silver at 103, you will have just handed them the heist of the century. Because what I'm about to show you using specific data from institutional reports is that $103 isn't the top. It's not even close. $103 is the starting gun. This is John AG Live. Today is Saturday, January 24th, 2026, and you're about to learn why selling your silver right now would be the worst financial decision of your life. Let's go. For 5 years, we've been screaming into the void. 5 years of being called conspiracy theorists. 5 years of mainstream media telling us silver was a Reddit pump or a meme trade. 5 years of watching YouTubers with millions of subscribers say gold and silver were boomer rocks. But here's what they didn't tell you. Here's what they couldn't see. The math was always on our side. According to the Silver Institute's World Silver Survey 2025, the global silver market has been in a structural deficit for 5 consecutive years. 2021, 2022, 2023, 2024, and 2025. Not cyclical shortages. Not temporary supply disruptions. 5 years of demand exceeding supply. The cumulative deficit from 2021 to 2024 alone was 78 million ounces. Let me put that in perspective. That's 10 months of global mine supply. Just gone. Vaporized. In 2025, the Silver Institute projected another 149 million ounce deficit. HSBC said it could be 230 million ounces. So when you add it all up, 2021 through 2026, we're looking at 800 to 1,000 million ounces Ghanaians of cumulative deficit. That's nearly an entire year's worth of global production that has been withdrawn from available stocks. You can't run a market like that. You can't have demand outpacing supply by 15 to 20% annually and expect prices to stay flat. It's mathematically impossible. But they tried. Oh, they tried. The COMEX futures market, the LBMA paper forwards, the unallocated accounts. They used paper contracts to suppress the price of a physical metal that was disappearing from the vaults, and for 5 years it worked, until it didn't. So here's what's about to happen. You're sitting on silver you bought at 1822s, maybe 28s, you're up 300%, maybe 400%. And some part of your brain, the part that's been trained by Wall Street, is saying, take profits, lock in gains, don't be greedy. Ignore that voice. That voice is a psychological weapon designed by people who want to buy your metal at $103 so they can resell it at $200, because what you're about to see is that the deficit is accelerating. The inventories are collapsing, and the industrial users are panicking. This isn't a speculative mania. This is a supply crisis entering its terminal phase. And if you sell now, you will spend the rest of your life watching silver climb to $200, $300, maybe higher, knowing you had it in your hands and gave it away. Don't do it. Let me show you the smoking gun. In January 2026, just 3 weeks ago, 33.45 million ounces of silver were withdrawn from COMEX registered inventory in 7 days. 7 days, that's 26% of the entire registered inventory bar vanished in a single week. Now, if you don't understand what registered inventory means, let me explain it to you like you're 5 years old. COMEX has 2 types of inventory. 1, registered for metal available for delivery against futures contracts. 2, eligible. Metal sitting in the vault but not available for delivery. It's owned by someone who's just storing it there. When someone demands physical delivery of a futures contract, it comes out of registered inventory. And right now, registered inventory has fallen 70% since 2020. From over 200 million ounces down to around 73 million ounces. So when 33.45 million ounces disappear in 7 days, that's not normal market activity. That's a run on the vault. But it gets worse. Go back to December 2025. In just 4 trading days, 60% of registered inventories was claimed for delivery. 4 days. The system is breaking. When you can lose 60% of your deliverable inventory in 4 days, you don't have a market anymore. You have a Ponzi scheme entering collapse. Now, the COMEX knows this. The banks know this. So what did they do? On January 7th, 2026, the CME Group, the people who run COMEX, raised the margin requirement for silver futures contracts by 47%. They jacked it from $22,000 per contract up to $32,500. Why? To kill the momentum, to make it more expensive to hold futures positions, to force speculators to liquidate. This is the same playbook they used in 2011 when silver hit $50. They raised margins 5 times in 8 days, and it worked. Silver crashed from $50 to $26 in 2 weeks, so they tried it again. And here's the beautiful part. It didn't work. Silver ignored the margin hike and blasted through $100, because this time it's not speculators driving the price, it's physical delivery demand. It's industrial users who need actual metal for manufacturing. It's Eastern buyers draining London vaults. It's a market realizing that the paper contracts are worthless if you can't get the metal. And then there's JP Morgan. In late 2025, JP Morgan moved 169 million ounces each of silver from registered to eligible status. Let me translate that for you. They took metal that was available for delivery and reclassified it as not available. Why would they do that? Because they don't want people taking delivery. They want you to settle in cash. They want to keep the metal in the vault so they can use it as collateral for other trades, or lease it out at insane rates, or sell it again when prices go higher. This is the same bank that was fined $920 million in 2020 for spoofing the gold and silver markets, placing fake orders to manipulate prices. You think they stopped? They just got better at hiding it. Now let's talk about London, because while COMEX was bleeding inventory, the London Bullion Market Association, the LBMA, was facing its own crisis. In October 2025, silver lease rates in London spiked to over 30% per 30%. For context, normal lease rates are 0.5% to 2%. A lease rate is what you pay to borrow physical silver for immediate delivery. When lease rates hit 30%, it means one thing: there is no metal available. People are so desperate for physical silver that they're willing to pay 30% annualized interest just to borrow it for a few weeks. And what happened next? London had to emergency airlift 4 million ounces into the vaults in October 2025, the largest single-month inflow in at least 9 years. So they pulled silver from New York. They pulled it from Shanghai. They scraped together scrap recycling. They pulled approximately 26 million ounces from private holdings that weren't even supposed to be in the market. And you know what happened after that massive inflow? Lease rates dropped from 30% down to about 5%. Because the system was literally hours away from failure. If those 54 million ounces hadn't shown up, London wouldn't have been able to settle transactions in physical metal. The entire clearing system would have collapsed. And here's the part that should terrify you, or excite you, depending on how you're positioned. The paper-to-physical ratio in silver is currently estimated at 378 to 1 down. That means for every 1 physical ounce sitting in a registered vault, there are 378 ounces worth of paper claims against it. Futures contracts, OTC derivatives, unallocated accounts. This system only works if 99% of people accept cash settlement instead of demanding delivery. But what happens when that flips? What happens when industrial users, Eastern sovereign buyers, and smart investors all say, "No, I want the actual metal"? The system breaks. And that's exactly what we're watching in real time. Now let's talk about why this deficit is about to get exponentially worse. In 2024, global silver demand reached 1.16 billion ounces. Of that, 680.5 million ounces. 59% went to industrial fabrication, and within that industrial demand, the fastest growing sector is solar energy. Solar consumed approximately 200 million ounces. In 2024. That's called 29% of total industrial silver demand. But 10 years ago, in 2014, solar was only 11% of industrial demand. It's nearly tripled. and here's why it's about to explode. The new generation of solar cells, TOPCon and HJT technology, require 50% more silver per panels than the old PERC technology, 50% more. And these aren't niche products. These are the industry standard going forward because they're more efficient. The European Union has set a target of 700 gigawatts of solar capacity by 2030. Each gigawatt requires approximately 112 tons of silver. Do the math. That's 8,400 tons just for Europe's solar build-out, roughly 270 million ounces, and that's on top of the existing 200 million ounces of annual demand. Researchers at the University of New South Wales published a study warning that solar production alone could consume 85 to 98% of global silver reserves by 2050. Read that again. Solar alone, not electronics, not EVs, not batteries, not medical devices. Just solar panels could eat up nearly the entire global reserve base in 25 years. And then there's artificial intelligence. Global IT power capacity grew 53-fold from 2000 to 2025, from 0.93 gigawatts to nearly 50 gigawatts. That's a 5,252% increase, and every bit of that computing infrastructure is silver intensive. AI server clusters contain 2 to 3 times the silver content of traditional data centers because they require higher power density electronics, advanced cooling systems, more circuit boards per rack. In 2024, the electronics and battery industry consumed 231.6 million ounces of silver, with AI terminals driving significant growth. And this is just the beginning. Every major tech company, Microsoft, Google, Amazon, Meta, is building AI data centers. Elon is building Grok clusters. OpenAI is building GPT-5 infrastructure. Every one of those facilities is a silver sink. Then you have electric vehicles. Each EV requires 25 to 50 grams of silver, 67% to 79% more than a traditional internal combustion engine. That silver goes into battery management systems, power inverters, electric motors, charging systems. And EV production is forecast to overtake ICE vehicles as the primary source of automotive silver demand by 2027. China alone produced over 9 million EVs in 2024. If global EV production hits 30 million units annually by 2030, which is the current trajectory, and each vehicle uses 40 grams of silver, that's 38.6 million ounces of incremental annual demand just from EVs. So demand is exploding across solar, AI, EVs, 5G networks, medical devices. What about supply? Surely the miners can just dig more, right? Wrong. Global mine production has been essentially flat out since 2020, with a compound annual growth rate of 0.9%. Negative. Let's look at the 2 largest producing nations. Mexico, world's largest producer, 2024 production, 6,300 metric tons. 2023 production, 6,289 metric tons. Growth rate, 0.2%, basically flat. Peru, second largest producer, 2024 production, 3,100 metric tons. 2023 production, 3,198 metric tons. Growth rate, 3.1%, declining. Why can't they produce more? 3 reasons. Reason 1. Byproduct economics. Approximately 80% of silver is mined as a byproduct of base metals, zinc, lead, copper, gold. That means silver production is a high side effect out of mining those other metals. You can't just decide to mine more silver because the economics are driven by the base metal, not the silver. If zinc prices are low, zinc mines shut down and silver production drops with them, even if silver prices are high. Reason 2. Capital intensity and development timelines. Building a new primary silver mine costs $500 million to $2 billion. And the timeline from discovery to production is 7 to 10 years. Even if companies started massive investment programs today, that new supply wouldn't hit the market until 2032 to 2035. The deficit is happening now. Reason 3. Declining ore grades. Average silver ore grades have fallen approximately 30% over the last decade. That means miners have to process more rock to get the same amount of silver, more energy, more cost, more time, and current exploration spending is 40% below 2012 peak levels, which means there isn't even a robust pipeline of future projects being developed. And here's where it gets geopolitical. In November 2024, the United States Geological Survey added silver to the 2025 critical minerals list. This puts silver in the same category as copper, uranium, aluminum, rare earths, and nickel, metals deemed essential to economic or national security, with supply chains vulnerable to disruption. This designation allows for accelerated permitting for domestic mining projects, federal investment incentives, potential strategic stockpiling programs, trade policies including tariffs to reduce foreign dependence. The U.S. government is officially recognizing that 60% of silver demand now comes from industrial applications critical to clean energy and technology. Silver is no longer just a precious metal, it's a strategic industrial commodity. And then China made its move. On January 1st, 2026, China implemented export licensing requirements for silver. They reclassified silver as a strategic resource aligned with rare earth export controls. This policy gives the Chinese government oversight on approximately 60-70% of the world's refined silver exports, roughly 121 million ounces annually. To export silver from China, you now need minimum production of 80 tons annually, credit lines exceeding $30 million. Government approval only. 44 companies received authorization for 2026-2027. Now, 2025 data shows China exported 5,100 tons, a 16-year high, suggesting the controls haven't severely restricted flows yet. But the infrastructure is now in place. If geopolitical tensions escalate, if the US and China enter a trade war or a tech war or a real war, China can turn off the silver tap with a single policy directive. And when Elon Musk publicly commented that China limiting silver exports is not good, given silver's industrial importance, he wasn't being dramatic. He was being accurate. Western solar manufacturers, EV producers, and data center operators are dependent on Chinese silver exports. If those exports get restricted, there is no substitute. You can't make solar panels without silver. You can't build AI servers without silver. The conductivity properties are irreplaceable. Now let's zoom out and talk about why gold is at 4,188. Because gold and silver don't move in isolation. They move in response to monetary system failure. And right now, the U.S. monetary system is in exponential collapse. As of January 7th, 2026, the U.S. national debt hit 38.43 trillion. Let me put that in context. 5 years ago, the debt was approximately 27 trillion. That's an $11 trillion increase in 5 years, a 40% expansion. The debt is now growing at an average rate of 6.12 billion per day, not per month, per day. At the current trajectory, the U.S. will hit 39 trillion by March 2026. The Congressional Budget Office projects the debt will exceed $52 trillion by fiscal year 2035, and that assumes no recessions, no wars, no bank bailouts, no new spending programs, which is laughably optimistic. But here's the part that's going to destroy the system. In fiscal year 2025, the U.S. government paid over $1 trillion in interest on the national debt. Let me say that again. Over $1 trillion. Just to service existing debt. That's more than the entire defense budget. $850 billion. Medicare spending, $850 billion. All non-defense discretionary spending, $900 billion. The net interest payment in FY 2025 was $970 billion, which represented 19% of all federal revenue. Think about that. Nearly 1/5 of every tax dollar collected went to interest payments, not roads, not schools, not defense. Interest. And it's accelerating. In Q1 of fiscal year 2026, October-December 2025, the government paid $104 billion in interest in just 9 weeks. The Committee for Responsible Federal Budget Projects interest costs will reach 1.1 to 1.36 trillion dollars in FY 2026, 1.5 trillion in 2032, and 1.8 trillion in 2035. But here's the kicker. The average interest rate on U.S. marketable debt hit 3.382% in November 2025. That's more than double the 1.583% rate from 5 years ago. And here's why that matters. Approximately one-third of marketable debt, 9.2 trillion matured by end of 2025. Another row of 9 trillion short matures in 2026. That's at 18.2 trillion that has to be rolled over at current interest rates. But that debt was originally issued during the 2010-2020 zero interest rate era when Treasury yields were 0.5% to 2%. Now it's being refinanced at 3.5% to 4.5%. This creates a refinancing ratchet, even if the Federal Reserve never raises rates again. The government's interest expense keeps climbing because low-rate debt from the 2010s is being replaced with higher-rate debt. It's a death spiral. And how does the government respond? By printing more money. The M2 money supply, cash, checking deposits, savings accounts, money market funds, hit a new all-time high of 22.3 trillion in November 2025. For context, in 1980, M2 was 1.2 trillion. In 2025, M2 is 22.3 trillion. That's an 18.6x increase in 45 years. The Federal Reserve balance sheet, which was under 1 trillion dollars before 2008, is now 8.9 trillion dollars, an 8 to 9x expansion. Oh, and here's the beautiful part. While M2 increased 18.6x since 1980, gold went from $500 Oz to $4,900 Oz here $9 Silver went from 16 Oz to $100 Oz here 6.25. Both metals have Kiri underperformed. The money supply expansion. If gold merely tracked M2 growth, fair value would be 500 x 18.6 to $9,300 per ounce. If silver merely tracked M2 growth, fair value would be 16 odd x 18.6 or at $298 per ounce. Now, this is a simplistic calculation that ignores productivity growth and other factors, but it illustrates the magnitude of potential repricing. If precious metals revert to historical relationships with monetary aggregates, and the central banks know this, that's why they've been aggressively accumulating gold for 3 consecutive years. In 2022, central banks purchased 1,136 tons of gold, an all-time record going back to 1950. In 2023, they purchased 1,051 tons, the third highest on record. In 2024 tours, they purchased 1,044.6 tons, marking the 15th consecutive year of net buying. Through Q3 2025, they added another, or 634 tons, maintaining the pace despite gold trading at record highs. Let me emphasize that. Central banks are buying more aggressively high at $3,500 to $4,000 per ounce than they did at $1,800 to $2,000. Traditional economics says higher prices should reduce demand, but central banks aren't reducing demand. They're accelerating. Good. Why? Because they see what's coming. Poland emerged as the dominant buyer in Q1 2025, acquiring 148.6 tons, nearly half its entire 2024 total of 89.5 tons. Poland's central bank governor is openly targeting 30% of national reserves in gold, currently around 17%. China added 12.8 tons to it in Q1 2025, and Huidari on 44 tons in total in 2024. And most analysts believe official Chinese figures significantly understate our actual holdings, with substantial purchases occurring through non-transparent channels. India purchased 73 tons oats in 2024, approximately 4x the 2023 volume. The breadth of buyers is stunning. Turkey, 75 tons in 2024. Brazil, 16 tons in September 2025. First purchase since 2021. Kazakhstan, Azerbaijan, Singapore, Qatar, Egypt, all adding reserves. And here's the institutional conviction. A World Gold Council survey found that 95% of central banks in Chile expect global gold reserves to increase over the next 12 months. 43% anticipate expanding their own holdings. 0 respondents expect declines. This is near unanimity among the most conservative, long-term oriented capital allocators on the planet. When 95% of central banks expect increased global holdings, that's not a trade, that's a big structural regime shift. So here's where we are. Silver just broke $103, gold is at $4,988. You're sitting on positions that are up 300%, 400%, maybe 500%, and Wall Street is about to unleash the most sophisticated psychological warfare campaign in modern financial history to get you to sell. They're going to crash the price 15-20% in 3 days. They're going to parade experts on CNBC saying it's overextended. They're going to publish articles with headlines like silver bubble bursts and gold profit taking accelerates. They're going to use technical analysis to show you bearish divergences and overbought oscillators. And some of you are going to sell because you've been trained by Wall Street to take profits. You've been trained to think that 300% gains are enough. But let me ask you something. If you bought Bitcoin at $3 in 2011, would you have sold at $10? Because that would have been a 233% gain. Pretty good, right? Except Bitcoin went to $69,000. That $3 investment would be worth $23,000 per coin. And the people who sold at $10 spent the rest of their lives kicking themselves. So let's do the math on silver. The gold to silver ratio is currently around 49. 4,900 gold, $100 silver. Historically, during precious metals bull markets, that ratio compresses. In January 1980, the ratio hit 17 tiaos. In April 2011, the ratio hit 31 pites. The long-term average is 50-61. Right now, if gold reaches the institutional targets, Goldman Sachs, $5,400 by end 2026, Bank of America, $6,000 by spring 2026, JP Morgan, $6,000 longer term. Bank of America has a 2026 silver range of $235 to $309. The midpoint is $209.22, more than I'd double-line the current price. And remember, Bank of America, Goldman Sachs, JP Morgan, these institutions have raised their targets 5 times. Within the last 12 months because prices keep exceeding their forecasts. They're not leading the market, they're chasing ticket. But forget the ratios and the targets for a second. Let's just do basic arithmetic. Annual silver deficit, 150 to 230 million ounces. Solar demand growth by 2030, so 250 million ounces annually. China export controls, potential restriction of China 121 million ounces. COMEX registered inventory, 73 million ounces. Down 70% since 2020, paper to physical ratio, 378. There is no scenario where these numbers resolve at 103. None. When industrial users can't get physical metal, when COMEX loses 26% of inventory in 7 days, when London lease rates spike to 39%, when China has export controls in place, when solar demand is doubling, the price has to go higher. It's not speculation, it's arithmetic. In 1979, silver averaged around $6 per ounce. By January 1980, it hit $50. That's an 8.3x move in 12 months. The deficit conditions then were smaller than what we're facing today. If silver were to reprise a similar move from the 2024 average price of $32, an 8x move yields $256. Great. Now, I'm not saying silver is going to $256 next month. What I'm saying is that triple-digit silver, $100, $150, $200, has a historical precedent and a mathematical justification given the magnitude of the deficit. So here's your choice. You can sell your silver at 103 and convert it into US dollars, a currency that's being debased at $6.12 billion per day, issued by a government paying over $1 trillion annually just in interest. backed by a central bank that's expanded M2 money supply to $22.3 trillion. Or you can hold a physical metal that has been in deficit for 5 consecutive years, is consumed in irreplaceable industrial applications, is subject to Chinese export controls, is disappearing from COMEX vaults at 26% per week, has a paper-to-physical ratio of 378.1, is being revalued in real time as the fiat monetary system collapses. One of those is a depreciating liability. One of those is an appreciating asset. Choose wisely. If you're holding physical silver right now, I want you to do something for me. I want you to comment below, Diamond Hands 103. Let me see who's in this with me. Let me see who understands what's happening, because the banks are watching these comments too. And when they see thousands of people saying Diamond Hands 103, they're going to know that this community isn't selling, that we're not falling for the psychological warfare, that we understand the math, and that terrifies them. Because if we don't sell, they can't cover. If we don't sell, the inventories keep draining. If we don't sell, the paper market breaks. And when the paper market breaks, the real renewal repricing begins. I'm going to say this one more time because I want you to hear it. $103 is not the top. $103 is the sonar beginning, Greece. The structural deficit is accelerating, not resolving. The monetary debasement is accelerating, not slowing. The institutional buying is accelerating, not stopping. The inventory drain is accelerating, not stabilizing. Every single pillar supporting this revaluation thesis is strengthening, not weakening. And if you sell now, if you trade your silver for paper dollars at $103, you will look back in 12 months, 24 months, 36 months, and realize you handed the banks the heist of the century. Don't do it. Hold your metal. Trust the math. And watch what happens when the dam fully breaks. Next video, I'm exposing the platinum squeeze mine that nobody's talking about. While everyone's watching silver and gold, platinum is setting up for a move that could make silver look tame. I'll see you there. This is John AG Live. The dam has burst, the revaluation has begun, and the betrayed protectors just became the victorious holders. Comment, Diamond Hands 103 if you're holding. Let's go.